Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome back to the Second Bite Podcast. I am your host, Todd Taskey. I am excited for our guest today, Tonio DeSorrento, the CEO and founder of Vemo Education. Tonio, super happy to have you join us today.
Thank you, Todd. It's a pleasure to be here.
Yeah, this is going to be a great episode with a lot of maybe slightly different conversation topics. So I'm really excited to get started on that. Before we do, I do want to take just a minute, thank our sponsors at Trivest. I don't know if you're familiar with them, Tonio, but Trivest is a private equity firm based in Miami, focused on working with founder and family-owned businesses. They've been on the Inc. list and the every list out there of founder-friendly firms. They've been in business for 40 years. They've done something like 300 transactions. A really good group. You can learn more about them at trivest.com. You can go to trivest.com/secondbite, and they've got some resource materials and things like that for people that listen to the program. So that's our thanks to our friends at Vemma at Trivest. Tonio, to jump in, Vemo, and we've been friends now for a few years. Vemo is something that fascinated me from the very first time we met and talked about it. Can you describe for us what Vemo is and the people that you serve?
Sure. So Vemo is known as an industry leader in income share agreements. Income share agreements are a popular idea. Imagine if you had, instead of a loan with principal and interest, a way to pay based on your earnings for something. So it means if you're buying something like an education, it's supposed to level your human capital up.
And that's where most of your application is, right, in the education space?
Yes. And so we came into the market. I learned about income share agreements as a lawyer, helping other companies try it way before Vemo. They had all ended up pivoting or failing pre-product market fit. And they were in this peer-to-peer space. I call that ISAs 1.0, income share agreements 1.0. Vemo and others who we in the market with us, I would say are like ISA 2.0. We got to product market fit. And I'm not trying to say this all past tense, but I'm a former CEO of Vemo as of this week. So we got to product market fit, moved a lot of venture capital through our system, moved a lot of asset capital through our system, helped a lot of students and worked with a lot of schools. But I think the future of this is going to be ISA 3.0. What you see in ISA 2.0 is these are specialists. So Vemo is built to make income share agreements. It's vertically integrated, and it's built to make them to solve a valuable problem. The valuable problem that Vemo solves is linking what people pay for an education to the value delivered. And Vemo's customers, perhaps counterintuitively, are schools, because there are thousands of places you can study after high school in the United States, ranging from code boot camps to community colleges to our Ivy Leagues. And most of them have a really hard time communicating their value to students. Like, why do they charge what they charge? Why aren't they free? What's the difference between them and a cheaper school down the street? And for those schools who stand behind the promise of upward economic mobility, who say, we're just not here to deliver a credential, we're here to help you get a great career path after school. That's what people are really trying to buy, by the way. This incorporating something like an income share agreement as some or all of their tuition lets them cut through the noise. So instead of spending money on marketing and sales, they're going to spend it subsidizing the financial outcomes of people who attend their school and don't get great value. And that's actually much more effective at converting.
And they're super vested in my success after my 4 years, not just my 4 years.
That's right. Well, a byproduct of what Vemo did, which, today I think it's maybe 85 school customers, including more than 60 colleges, creating the first outcomes-based revenue stream at a lot of nonprofit organizations that are revenue dependent, but not outcomes dependent yet.
Right. And so Vemo is Vemo.com, correct? The website?
Yes.
And it is fascinating to me because it does really solve a problem of, from the student's perspective, if the school is more expensive than I can afford or my parents can afford, I don't have to be laden with debt and fixed payments. I'm just going to share my revenue going forward. Some people think that's wonderful. Some people think that that's predatory. Then they're all entitled to their opinions. What I'd like to focus on is you were a leader and in many cases a visionary in the space in terms of what you created, and that's super hard, right? But I'm hoping what I think would be interesting for our listeners, I'd like to talk about what it was like raising money, what it was like in terms of equity for you because you had co-founders, the notion of preference versus common versus what people refer to as the capital stack, who owns what inside the company. So maybe you could just kind of start at the beginning when the company started. How did you guys raise your first amount of money, and what were the economics that were involved around that?
We're really fortunate we started. We had the support of a backer named Lauren Abney, who'd been a successful public company CEO a number of times. And so we were able to circle enough money to cover payroll pretty easily through Lauren and his connections. We didn't have that complete phase of everybody works for free for a very long time.
Right.
We're very fortunate. But
Yeah.
that was important because what we were building at Vemo required functional expertise from lots of people who were functional experts. And you don't find them often among startup addicts. You find those people at mature businesses, mid-career with families, and so you have to pay them. So with Vemo, I had 3 co-founders, but all 4 of us had families, and we're not already rich, and so or liquid in a sense that we could just go without salary for a long time. And so it was very important for Vemo to start with some money. And I would say what let us get from 0 to 1 there was maybe just biting a bullet on that. There's a lot of people will say the right way to do a startup is you got to bootstrap this thing as far as you can. And that's
Keep as much equity as you can, right?
yeah. It was just like, how lean can you get? The question for us at Vemo, though, wasn't like, can we very leanly construct a system for, both the data and the software to move dollars and pixels back and forth based on somebody's income?
Right.
The question is, can we construct a management team that a college will look at and see as a peer? Because our business was dependent on convincing colleges to integrate with us. And the smallest little nonprofit college, the CFO's a 15-year nonprofit finance exec. The general counsel is a real lawyer, takes himself very seriously. And the privacy person wants to know that maybe you have a stock audit. There's these things that you have to have the minimum viable unit to succeed in winning a college customer for something like we were doing, which was integrating with their money, their data, touching their students. It was a fully formed management team. So I had to make all this stuff, my co-founders and I, and our early backers, without any revenue.
Right. And then you have to convince a school to institute this program that they're not going to truly see any benefits for 3 or 4 or 5 years. And you guys have to be around for 3 or 4 or 5 years.
Yes, I'm saying create some financial assets with me that I'll oversee for you for a very long time. Meanwhile, I have 18 months runway, right? And nobody's ever allowed to do that normally, right? And so, like, immediately prior to Vemo, I had been part of a startup called SoFi. It's not a startup. When the SoFi's founders and early executives were constructing that business, we were able to rely on a lot of external infrastructure that already existed because our first product, was very similar to other products that already existed. Refinancing student loans means you're going to take regular student loans and just switch who you're paying.
Right.
So the machinery for that, the pipes existed, and there was a way for SoFi to not have to own every layer of their business. At Vemo, we said, we're going to run that same playbook. and it just didn't work. Income share agreements in 2015 were so different and so small, honestly, relative, so different from what was market in loans, and then so insignificant that nobody was going to customize their system for us, and it would take massive customization. So we were forced to build the whole thing to get our first big enterprise customer, which was Purdue University. We had to insource every layer be vertically integrated, and it's a terribly inefficient way to start a thing, but it was the only way for us to get started.
So the CEO investor, is he your fourth founder, or he was just the investor and there's four of you guys working it?
There's four of us and Lauren. Lauren was very involved early, but we were starting a company in Northern Virginia. He's based in Austin, and he was still CEO of another company.
And that was what year you founded?
2015.
So there's four of you as founders. Did you own equal shares?
We didn't split that equally. I knew that I was starting the company with my co-founders were not at the time startup people. We've all become startup people, but this was my third or fourth, depending on how you count it, venture-backed startup in a row, and I knew that I would be trying to work the stock the whole time, and that they would care maybe more about getting paid fairly,
right,
in the beginning. So we did not split equally. I had an unequal share, although the others were all equal. And
so you took a little bit more risk based on income, but got a little bit more equity.
Yeah, and I would say it takes investors want to be negotiating with a person, and you have to seem like the one who's in charge. I mean, I could have, if we had immediately exited and I just had a bunch of money and I felt like I hadn't contributed, I suppose I could have split it up with other management team members. But and then if you own below a certain number, an investor won't take you seriously. They say, who am I actually negotiating with here? And so with four co-founders, it's you start in an early investor and real salaries from the beginning. You start to split that equity up pretty hard.
Sure. So Lauren throws in, that gets you a little bit down the road, but now you need to go and raise your first round.
Yes.
Tell me about that.
Oh, this was brutal. The thing about what we were doing at Vemo is it had been tried many times, and everybody else had pivoted or failed, even brilliant people like Dave Gerard at Upstart. So I'm going around to venture people who would totally take the phone call or the meeting, trying to explain, I have this thing. Here's what it is. They're looking at it going, we've all seen this. It's not going to work. It was really hard. So I ended up having to help fund the company myself a little with some SoFi stock proceeds, where it took a lot longer than I thought. Even though I thought, man, I'm a venture pro. I've been in other businesses, I've made other people money before. This will come to me easily. I met with 83 different investors or funds.
Wow.
83 meetings. Some of them were multiple meetings. I had 83 different. If you think about like a CRM, or a funnel.
Yeah.
My funnel, the top of it, I don't even know, but the meeting stage was 83, and we got one term sheet.
Wow.
We closed.
Yeah, of course you did. Right. Excellent. So now let me ask you this. You mentioned something that I picked up on, which is take the call. Everybody took the call. And that's a credit into itself as a guy that spends a lot of his time trying to get people on the phone. Is it because you were from SoFi? Because you were a SoFi graduate? Is it because of the idea? Was it because of something else? Why do you think you had so much success having so many calls? Because 83 is a lot. Yes,
very fortunate. And this is pre-Zoom, so they were mostly in person. It's going all over the place. I'm very fortunate in two senses. One, I had paid a bunch of dues as a lawyer in private practice, just helping lots of people. So I'd had customers for whom I'd done good things and helped them and made sense. There were venture funds who would call me and say, hey, is this company good or not? I was a venture partner at an ed tech fund called Learn Capital. I was helping people a lot, and I wasn't asking for anything. So I was helping on a friendship basis most of the time. And I think that let people drop their guard around me and see who I was and appreciate me that way. They say, sometimes people say it's not what you know, it's who you know. And I would flip that and say, it's who knows you and what they know you are, for what you are known, right? What do they know you for? I was known for being helpful and decently curious and decently
And a,
smart.
and a good guy.
Yeah. The separate thing though, it didn't hurt to be coming out of SoFi because SoFi, there's things that you have to experience to be able to, I think, to mimic. Like, if you haven't worked at a professional services firm, you might not have understood what it really means to have like excellent work product
Right.
because the some giant banks paying you tons of money to work on a deal. It's so that there are zero mistakes in that thing. It's not
Mhm.
just to get it over the finish line. It's a very different mentality. And I think something I got to experience at SoFi was blitz scaling. You know, you can't buy that. And so people thought, well, if this thing works, there's a chance Tonio might be able to stay on top of it,
Right.
after having helped stay on top of a similar kind of explosion at SoFi. And I was really fortunate, I had good relationships with a lot of the of SoFi's partners and stakeholders there. So yeah, it really did help. I do think helping people generally and also helping people make money are great ways
To make
to get your phone calls taken.
So your first round then, can you give me an idea of roughly how much you raised? I think it's on Crunchbase and other places as well.
The first in 2016, it was a seed round of a total of $3.5 million.
Got it. And so when you bring in 3.5 million at a stage like that, how much of the company do you have to give up as a ballpark?
Well, that was punishing dilution. I'm just gonna. I mean, I'll be really honest. We fixed it later in that by succeeding later, we anti-diluted people like me some, but we gave up. That was like 3.5 on like a 3.5 pre-money.
Okay.
Yep.
So
SoFi's first round was 4 on 4. So to me, it was like the SoFi did that in 2011. So it was like a different era. But to me, it was like, oh, I'm not getting a great deal, but also this is a crazy, broken, risky thing. I haven't even launched yet.
of course, and
Yep.
somebody's willing to put up 3.5 million bucks.
Yeah,
So
thank you.
so they roughly had about half of the company.
Yes,
And so your equity got cut in half.
everybody. Yeah,
Right. So when you say you corrected that later, what do you mean by that and how does that happen?
sure. The next time we sold stock a number of additional times. The next time we sold it, and
When you say sold stock, does that mean your next round? Just so
fundraise. Yeah, I'm
people know
sorry. The
that?
next time we raised money
Okay.
was in 2017 in a venture fund on our cap table, Next Gen Local,
Mhm.
volunteered to mark the company up in an inside round as a seed extension. They said, "We want to give you more money. We don't want you to have to go fundraise, and we're willing to increase the value of the company." And when they did that, it was in recognition of some progress we've made and the great relationships we built. They didn't insist. The investors didn't try to take 100% of that price per share in the form of price per share. They actually took some dilution themselves to add more options, stock to the management
Right.
team's
So
plan.
the company, when the first round closes, let's call it, is worth about 7 million bucks, right? Approximately. So then a year later, Next Gen says, we're going to put in X million. We're going to do that at a valuation that's what, 15 million, something.
Yeah, something like that.
Okay. So they put in another slug of money, and the dilution to everybody is a lot less to get more money.
That's right. But they accepted on the investor side, to their credit, said, we don't want all of this as a markup on our price per share. We're willing to make some extra shares and just give them to management. So
Right.
we got extra stock, which anti-diluted us. We did not dilute with that round.
Yes. So they get. So now let's pause that for a second. Let's talk about when you have an executive pool, because you have one in Vemo, right?
Yep.
Explain that in as common of English as you can, so people know we've got a cap table. It's 4 people. Now we've got it with investors, and everybody agrees we're going to have an executive pool of some money over here. What's the impact of the cap table, and what is an executive pool actually all about?
Yes. So yeah, we start a company. When you first start it, everybody can just have stock because you can buy it because the stock is worthless. So you write your $50 check or your $500 check, and now you own some of this company. But as you start to make progress as a business or sell stock to outsiders at a higher price, new stock would be expensive for somebody to buy. Instead, what we'll do, we do want to compensate people though for working there. We want to compensate them with equity so that they're aligned. And what companies do in that case then is they create an option pool where they're able to issue stock options for a class of stock that is junior to the investor stock. So in venture-backed businesses, it's common these days, and it's been common for a long time, that investors, when they buy stock, they get a preference with that stock. It could be a bunch of different kinds of preferences, but a simple way to think of this is if you give me $1 million into my company for 10% of it, you've said the company's worth 10 million now. You have 10%, you give me $1 million. But we're not going to do this thing where if I sell it for 5 million, you get 500 grand. We'll say if I sell it for 5 million, you get your million back. You get your million back. So your preference is I'll give you your money back first.
Yes.
If that's true, then with all of the risk in an early stage business, the stock that is not preferred is worth less than this worth less, right? If I sell for 1 million, you get all of it, I get nothing. So my stock is riskier and therefore it's worth less. And I can give you an option to buy that junior stock, which we call common, at a price that's advantageous to you without causing any taxable income event.
Right.
And then as the stock in the company appreciates, because we've successively sold stock at higher prices, the value of that option to buy at a junior price gets more and more valuable. In an event where everybody sells the company or goes public, the people who own the top stock, the preferred stock, have to convert into the common to participate in that. So if they want to have the benefit of an acquisition or an IPO, they convert and become like you. And when that happens, all the stock prices become one. And so these options can become very, very valuable. And it's how we keep everybody motivated and aligned in venture-backed businesses.
And just to comment on a couple things there, because sometimes the reaction some people give is, well, why do they always get their money out first, right? Theory is they put in $1 million, you took the $1 million and spent it on the business somewhere. So since you consume that, I should be first in line to get my money back, right? That part's number one. Number two is the preference that you just mentioned is a one-time preference. Depending on the company, and it's less common these days, I think, that preference could be $2 million. So if you sold it for $5 million, these guys need to get a return to satisfy their investors. Maybe they are dialed in for a return of $2 million no matter what. And then your percentage of what's left over is what's left over. If we sell it for, and I just want to comment on this because this, again, depends on your documents, but if you sell it for $50 million, they own 10%, that's $5 million. Depending on the documents, if they get their preference first, that means they get $1 million. Then they get 10% of the $49 million left over. So $4.9 million. So they got $5.9 million on that $50 million sale. So it depends if it requires a conversion into common or not, or if they always get to hold their preference. And that's why you got to have a really good lawyer, right?
Yeah. So we worked with Brian Burke at Cooley. And I had been a lawyer before, a securities lawyer and startup lawyer and consumer finance lawyer. I'd done all the things at SoFi. So yeah, we were very fortunate. We had non-participating preferred and a 1x, one times preference to the senior investors. And we were able to hold the line on that. There's times when it makes a lot of sense to do that. Imagine if I were going to try to sell the company soon and I wanted to have a comp price that was really high. I might say, I'll give you 3x. Todd, I want you to buy some of my stock. Give me $1 million. I'll give you a 3x preference, but give me a $200 million valuation. And in real life, I was only worth 75 the day before this deal. Like, sure, I'll give you $3 million to put another 100 to value into my enterprise and my comps, right? So that's exaggerating, but you'll see more mature businesses play that a little more seriously, or they'll say, I promise you, I'll 2x you, minimum 2x, minimum 3x in a pre-IPO round. Just if you're only selling a little bit of the company because they're trying to set a high comparable price.
Yes.
So
Now, and your guy at Cooley is Brian Burke.
that's who I've worked with. But I also knew Mike Lincoln and others there.
Yeah, Mike Lincoln's very well known here in DC. Brian Burke, Cooley's a great shop. I think the point in this conversation is if this sounds confusing, make sure you have a really good lawyer.
Yes, it's worth it. Look, if you're going to build a thing that's meant to bear scale, if you're going to invest years of your life in it, this is one of those things you'll have to do. It's a cost of doing business, even though it's not free. And I think, if you have a way to avoid all this and own the whole company and build it, you don't need outside money. You don't need to carefully document every stock transaction today so that nobody sues each other over it in 5 or 10 years. Maybe you can skip that. But I already knew that I couldn't skip that.
Well, yeah, and it's interesting because what I find is people try to do it on the cheap the first time because other firms sound like they're expensive. Cooley and others have done a great job of not being expensive to early stage companies. Guys that go the second time around never even think about it. So now let's move on, right? So now you've gone through 16, gone through 17, everything's going along great, and life gets challenging, right? Next time around, take me through some of the challenging part.
Well, I would say 17, 18, we were really fortunate that things continued to kind of go our way. What would happen is we had a lot of clones. So the idea we made it look too easy, right? And because we had spent so much building our platform, we had to charge a lot. Our clones could come in, kind of copy the easiest things, pick off. They didn't have to figure out which schools wanted to do it. They could just figure out which schools had press release they'd done stuff with us, and then call them. So and then try to cut us on price. And so it was kind of tough. But on the other hand, we never lost an RFP because I don't think Vemo's lost an RFP yet. What would happen is they'd get a school excited and either call one of our customers, and then we'd have to play a little defense there, or they'd excite some other school who would then Google it, start calling other schools who've done it. And for a while there, we had 100% market share, and so that was going all right, and it even drove some investors toward us. Back to the investor story. The next time we took money was in spring 2018 on a convertible note from a Wall Street-based investor, where they were excited about the asset class and they had been talking to other companies in the space. And but as they met the people who ran them, they couldn't explain it very well. And it just didn't make sense. And it's because those folks had only limited contact with us and were really just mimicking a lot of our movements. I'm sure by now, obviously, people learn, right? All those competitors from that era are mature and great at what they do by now. But at the time, they weren't inspiring confidence in people. So the next 6 million I took from people was it came right at me. Came to a conference in New York
in 2018.
Yep, convertible note in 2018, and this again, sophisticated credit investors was in their conference room. They asking all these questions. How do you know so much? If you've ever been one of those, you show up to something and they know all about you. Like, how do you know that? And because they'd been talking to people, and what they said was, we just want to be a part of this. How do we get in? And I was like, well, you write it on a note. We don't have to set a price. I'll get some venture capitalists to price it later. How much do you want to give me? And I was willing to take up to 6 million. So that was done on a handshake.
And where were you at that time? Were you at a point where you're like, oh my God, I can't believe this is a gift because we're running low on funds? Or was it more of a, wow, this would just allow us to go faster and do things bigger?
I was going to have to raise money that fall. So it was like March maybe. And I was going to have to raise money in August, September, probably. And
that's a big lift you don't have to do now, right?
I didn't have to, but what it let me do, in hindsight's 2020, maybe I didn't do this right, but I thought, boy, we were getting so many logos, and I have the chance now to buy some talent. So I went out and started spending on some talent that I'd wanted, swapped out some vice presidents. You get the best people you can. Like, there's athletes and position players in startups. Athletes do their best. You love them. They stretch. They do stuff they didn't learn before. But as you mature as a business, you need position players, people who hold up as institutional. They'd be vice presidents of a $1 billion company. They have giant talent trees they can pull from. Somebody who's been a VP of engineering somewhere else can hire engineers. They know what good ones look like. They have tons of buddies. Or apprentices or proteges they can yank into your company. They get favors out of contractors. It's the best. And so I started loading up on talent, and we started pushing for more logo acquisition by hiring more salespeople. And that took us into the fall when it was time to raise again, basically. It seemed like a good time to raise. We had good momentum.
Got it. And then what was the impact? So now we're creeping into 2019, then 2020, and then COVID happens, and then challenges come into the industry. Tell me about that.
Yeah, first challenge was getting all these logos. We were kind of giving stuff away and figured we'll turn the money on later. And it was harder to turn the money on than we thought. To start charging the money, it took a little while. But
now, when you say turning them on, right? So if they're going to integrate with you, and then they're going to put students in here that are deferring, if you will. I'm sorry if I'm not using the right lingo, but instead of paying $40,000 for school, they're going to pay $20,000. They're going to borrow 10, and they're going to do an income share agreement for the other 10. So they're starting to integrate with that, and they don't see any of the development work, any of the integration work, any of the stuff that's gone on behind the scenes on your end, right?
Right. Well, first of all, if you're just trying to get a logo at a college, you could say something like, "Well, you only have to pay me if you use it." You could say these things like, "Well, we'll show you how it works. You try it if you want." And what happens is adoption's low because you didn't go in there and solve a valuable problem,
right?
And you didn't ask them to commit on their side. I mean, look, ISA's income share agreements, Vemo, it's about skin in the game, right? Well, I didn't have my customers having any skin in the game. I was this optional thing. And, maybe the person who was signing my contract hadn't even really run it by all their colleagues that, hey, I want to do a lot of this. And when they go to turn it on or to use it, they're like, well, let's wait till next year. Or let's not do so much. And so it did not come out like we wanted. Now, in the meantime, I had raised the Series A. I was really fortunate. I did one of these things where I pitched somebody, a VC, a venture capitalist, a renowned one. He shredded me. And I gave up. I said, I'm not even going to try this. I went to San Francisco, hung out with some friends, rewrote the whole story, came back, gave the pitch one time to my board, and an insider bid to lead our Series A. So we're really fortunate. They said, you know what? I got it. It makes sense. And they bid. And so
when you say they bid, tell me what that's like. They say, we'll give you $5 million, but we want 20% of the company, or do you say, here's how much we're willing to sell, here's our valuation?
Yeah, you can try that. Some companies can set their own terms. I do think it's important to try to let the market set that. It respects investors because I'm selling something similar and they're trying to buy something similar, but they really do buy slightly different things, and they have different freedom of maneuver to be creative with deal structures, depending on the nature of investor, the stage they normally buy, how big their fund is, there are other specialties, there are other portfolio companies, the talent that's at the fund. So what we said was we had an investor say, what's the highest bid you think you'll get from an outside venture capitalist? And I told him. And then
when you said the highest bid, you're talking about the valuation or
pre-money valuation. Yeah. Like, what do you think the fair pre-money for this is? And I said a number. And he said,
do you remember what you said?
I do. I said 45 million. And he said, would you do it for 50? If I sold you 50, is the deal mine? And I said, yes. I'm off the road, deal's done. So everybody else had to follow on that price, right? So then every other investor who wanted to own some stock would call and say, oh, I think this is great. Let me get in on that.
So is it fair to say the value's 50? If I called you and said, hey, I want to put 5 in, that means I get 10% of the company?
You own, well, the post money is, if the total round was 5, right, then you'd have an 11, because you'd have 55 million of value, right, and there'd be 5 in cash, and you'd have 5 of 55. I took a lot of money in this round. So it ended up being $18 million that we took.
At 45.
At 50.
At 50,
we pushed it, right? Yeah, so we pushed it, and then that note converted, the old note.
And plus, that first guy coming on board just really set the mark for you. That was fantastic.
Yes, and so it let us have this. We weren't disrespectful to anybody, but as investors would say, "Hey, I really want to buy some." I'd say, "That's great. Here's the price." And they would say, "Oh, I hate that price. I understand it's a pretty unreasonable price, but this is what we've done."
It's where the market is, right?
Yeah, yeah. And so some investors worked really hard and got creative, or they bought smaller pieces. I think everybody who really wanted to own some still found a way to get in, and we
Mhm.
we worked with some great people through that round too. So that was fantastic. And I know
Yeah,
you say that because we were telling his fundraising story. I know you were asking about the challenges.
no, no, no. This is great. Let me ask this question because we did an episode with Rob Ray from Whitebox, and they've been very successful. They're an e-commerce company. We did a couple episodes ago, so if you want to go back and check that, you can. Rob had blown up his last company, started from scratch, didn't take income, blah blah blah. He did a raise in there somewhere, and said, he raised his hand and said, I need money for my family, right? I'm distracted because I don't. Did you ever get the opportunity to take money off the table? And did you ever have concern about the message that would send if you asked to take money off the table?
Well, I'd seen it done. SoFi offered secondaries pretty frequently, which is what that is. Selling some money, selling some of your stock alongside the company to investors who want to own some. I wanted Vemo to get the money that we were raising. On the one, two, I was still greedy for more stock. So we actually management got more stock. Every time we marked this thing up, we were trying to get more stock because we wanted to. We just didn't feel like the story was over here. We were really ambitious, and so um, I might have been able to get away with it then. And I know how that would have gone over. I probably would have had everybody sell some alongside me, but I
Sure.
didn't do it, and instead tried to just keep pushing and was greedy for more stock.
Well, you call it greedy, but at the same point, you went from a $5 million valuation, in 2015 to a $50 million valuation in 2018. I mean, this thing's only going to the moon, right?
Well, that's the plan, right? Like that's you have to. A thing that I learned here is regardless of what else I'm good at, the thing I had to never stop caring about or being good at is telling the story of the company and also of its stock. And so um, I would say, yeah, I had internalized that story. So
Yeah. Jeez. So then you today, right? We're in Q4 of 21. You've just recently rolled out to move on to your next adventure. Talk to me just about as you started to realize and look at what some of the challenges that you were facing in the business, how the preference on the cap table impacted and how you got to the decision that maybe it's time for me to do something else.
sure, BMO is a highly regulated. It operates in a highly regulated environment. All of our customers are regulated. They're schools. They're licensed or accredited or something, owned by a state or municipality. And then we're a financial services business, and everything about moving data, credit, reporting, all the terms, the disclosures, everything about that's regulated. And but it was a fairly novel product, and so regulation, you can interpret that more than one way, right? That makes you kind of an orphan sometimes. Somebody can just show up and say, especially on the enforcement side, I look at you and here's what I see. And you really can't argue against it. If they don't see something they like, um, there's nothing written anywhere that protects you from that.
And you become the bad guy overnight.
Yeah. So if you're Coinbase with a $50 billion market cap and 4 million retail customers, you push back hard. Or if you're Uber or Airbnb and it's decentralized. But in my case, in Vemo's case, it was federal education and financial services regulators took a point of view on this in the past year, especially that they didn't appreciate some features of our products and they wanted to change them. And they they communicated that, kind of suddenly with a consent order on one of my competitors. So what that meant, the challenge then is like, we have all this technical and operational debt. How do we deal with that? We're not going to be able to grow responsibly because we need guidance on how to comply with all the new rules. And our schools are very risk aware, risk conscious, if not risk averse. And so there's all this stuff, these important ingredients to our success that are going to be missing here. And BMO was not valued. We were Inc. 586 or something, right? In 2021, high growth. valued based on our growth, not based on our fundamental financials. The company was not profitable.
Right.
And so what do we do without growth? Right. That really hurts. And so coming into that, now I'm looking at this going, well, I've sold now by that point a total of $40 million.
You've
I've accepted $40 million of cash from outsiders in one form or another, mostly in preferred stock. And the first 40 million then of anything that happens there goes to them, as it totally should. They put me in the driver's seat to make my dream true, and they trusted in my vision, and they backed me for years over success. Most of them bought stock multiple times. So they've been trusting me and backing me at whatever crazy price I set. And now I'm looking at like, man, I don't know if I can deliver. And it's scary to look at that. And so we had to stop and think, like, is there a way to win here? What's the better part of valor? Is it fight another however long and maybe beat this, what we call preference stack? Or is it do something else, like sell part of the company, or downsize it and run it for a cash flow and give the investors back a little bit of money each month? And those are important strategic decisions, but for me and for all the management team members, we're a junior to that. We're in the common stock. And in my head, that common stock, the value of that changed really, dramatically in the past.
So let me pause there 1 second. These are really important decisions. And there's like a lot of the guys and women that listen to this podcast, they own their company. There is no majority owner here, right? You've got, a nice ownership stake, but still a small minority, right? To 100%. How are these decisions getting made? And is it contentious? Are people angry? What's going on?
Really fortunate that everybody was professional and nobody got angry. I give so much credit to all the people involved in this. Like, the investors are all real pros. And I feel like the management team members and I were also pretty professional about it. As you watch a thing maybe not work the way you wanted, we were all pretty grown up about this. But people look in these cases, they often look to the investor with the deepest pockets. They say, look, whoever's put the most money in, whoever is the biggest fund here, they probably have a board seat already. They're on the board, they're repping a class of stock. And if they want to push a strategy that requires capital, they can just throw some in. They also, if they're a big fund, will also maybe have access to operating executives if they want to swap it. Management.
And so does this fall to NextGen?
No, NextGen is not one of our bigger owners at this point. They're fantastic backers, and they totally put us in the position to raise a good Series A. And we're really grateful for them. This was actually a big New York outfit, and it's not even a venture fund. So you get to a point, also as you're raising money, that you outgrow seed stage venture funds.
Right.
There was no
you're
more
dealing with, and you're dealing with an individual, which is probably the partner or a principal at whatever the venture or private equity or institution is.
Yeah, partner, a junior or mid-level partner at a.
So then let me ask you this. So you hired, scratch that, Vemo hires Cooley to represent them in this whole process.
Yes.
Along the way, Tonio says, geez, I might want to go do something else. I imagine you go to Brian over at Cooley. Does Brian have an obligation to say, Tonio, I work for the company? What's that like?
Oh, I know this for being a lawyer, man. They work for the company. Don't say anything to a company's lawyer that's not, that you don't want said.
The company to know, right?
Yeah.
So did you not go?
You got to do their jobs, man. And I was on the board too, so I'm repping shareholders who are not me.
Right.
And so
So how do you manage a complicated situation like that?
Communicate a lot. Be really honest with everybody about
to your board member, your fellow investors.
Yes. Be just transparent. I was as transparent as possible with everybody, my management team members, with my investors. I gave as much access to everybody as I could, and just paint an honest picture about things. Maybe people don't agree or they don't like what you say, but be straight about all those things and accept that. And if I do think there might be a conflict, I got to get out of the way.
And what's that like? Is stress through the roof for you? You have government regulation, you got investors, you got employees. What's that like personally?
It used to really stress me out. As this stuff was starting to ramp up in 2019 from advocacy organizations, it really got to me. I've been a part of a group called, this is kind of wild, I'm going to drop their name, the YPO. And
Sure. Young Presidents Organization, YPO.
I'm in this group with these guys, all these different businesses. A lot of them own their whole thing. Some don't, some venture back. They don't care what I do for a living. Like, we're just actual friends and value each other. And it was this experience of bonding all these people. And I'm starting to tell them my company's going sideways over some of this regulatory stuff. And they don't even know what I do. I realized that I am not the company, and I knew that before. I have a happy family life. I'm very grateful for my wife and children, and my extended family. So I have these things that aren't my personal value isn't just this thing. And so it really that distance was important. I think everybody should seek it, even if it's hard, and no matter how much your company's your baby. Separately, I've gotten better over time at accepting things that I cannot change, and then driving really hard at anything I think I can change. So if I own or control, so if it's within my control, I hold myself accountable to that, hold my management team accountable to that, and I'm an unreasonable person. Like, I'm very demanding that way, and I can lose my temper, and I can chase people hard, and not everybody loves that, right? But I don't compromise. If it's not within my control, I don't chase it. I say, it's 0 strokes. We're not even don't even look about it. I'll just write it right in Slack. Nobody even look. Don't even worry about it. Don't even read the article.
Yeah.
I don't control those people.
It's so helpful when somebody that's been through a difficult experience is willing to share and talk about what that is in the level of detail that you have. And so that's super appreciated. And I'm sure everybody listening appreciates that as well. So I just want to say thank you, because I know that that's difficult. I know we're kind of coming to the end of our time. Is there anything you can share with me about what you're thinking about next for you personally?
Happy to.
You must be on to what's next, right?
Well, I've got ideas. Look, I didn't quit Vemo because I was tired, right? I have another company in me. I love fintech. I have a lot of thoughts about where there's opportunity there. And so what I've been doing past number of weeks, and what I'll continue to do for a number of weeks, is take inventory with investors of like where they see gaps in the market, talk to people I really respect about similar things, follow up with old talent. I can't poach out of my old company, but if I were to start a new one, where are the great vice presidents and directors that I can get for that? And so I'm just trying to keep tabs on all these great people and hear what they love and what they see. And, could I ever get them? Because one thing I learned from this is these companies are just people, right? And if I succeed in anything else I build, it'll be because I was able to bring in great talent, and that lets us win versus pick your person.
Yeah, that's fantastic. Last question, and then I'll let you run. You've been really successful. Your time at SoFi, your time at Vemo. You've also been successful, as you just alliterated, on a personal level with your family life and community life. Is there anything that you could point to? Maybe it's a book, maybe it's an experience, maybe it's a mentor at some stage that's had a lasting impact that you think you would credit more than others with where you are now?
Yes, I want to mention Rob Lavitt, General Counsel at SoFi, who mentored me from like law school, just to show me how to deal with complex things and how to maybe touchy situations as an executive team member, because general counsels have to deal with tough stuff that way. But the person who really changed how I think as to this role is that Lauren Abney, who I mentioned earlier in the podcast. He would say, from now on, your job is to drive the stock here. This cap table is you. And I don't want to sell it. I like products. I like building stuff. I like making things. I like, all of the doing. He's like, no, you can do that if you want, but this is you from now on. You're the vehicle for the stock here. This whole thing. That's the story. That's how investors come in and get paid. That's how you're going to pay your people. Companies, your customers want to buy from a winner. Like, this is you, and you have to be great at this storytelling. And I really wasn't when we started. But he would just talk about this all the time. At the time, he'd been a public company CEO like 3 times. I think he's done it 4 times now. And he would just talk about how that's it. This is who you are now, and accept it sooner and you'll be happier. It took me a couple of years, honestly, to get there. So it's like weird. I wasn't even talking to him regularly. And then all these conversations are coming up. And now I find myself talking to other people who are a stage or two behind me at startups, other founders. And I'm giving this stuff right to them. And I can see nobody's said it to them. So that's where I would say, if anybody's listening to this and you're starting a company or trying to raise money, remember who you really are here. Remember what your real job is if you're going to take that kind of money into a C Corp.
That's a great way to end our episode, and it's great advice. And again, sharing as much as you have all the way through here has been terrific, Tonio. So I'll say thank you to you. I'll say thank you to our friends at TriVest again for supporting the podcast. And Tonio, super excited to see what comes next for you. So we'll be watching. People can find Tonio DeSorrento on LinkedIn. Tonio, thanks for being so generous with your time.
This is great, Todd. Thank you very much for having me.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.